Good afternoon, ladies and gentlemen. Thank you very much for joining us for this very important and very interesting webinar this afternoon, and for the panel discussion that comes with it. I'm Dr. Damien Vives. I'm a director at PH Attorneys. And on our expert panel this afternoon that I'll be facilitating and hosting for us is Brendan Jones, who's the CEO and co-founder of the Adansonia Group. We have Francois Fouchier, who's a director at PH Consult, Tanya Strauss, as director at PH Tax and Accounting, and then Andre van Niekerk, who is our head of estate planning and administration at PH Fiduciary. A very interesting time for a discussion like we're going to have this afternoon, not just in relation to decoding the budget speech, but also how that positions within the bigger picture of not only what's happening domestically, but internationally as well, and what those considerations mean for us. There will be an opportunity for discussion in relation to some questions at the end of the webinar. So if you have any questions while we proceed, please feel free to jot them down, pop them in the Q&A feature at the bottom, and we will address those at the end of our discussion. All right, jumping in as a point of departure, Francois, what do you make of the budget speech? Do you think that there will be a movement to repatriate money from offshore?
Damien, I think it's been quite a fascinating process this year. It's something that we haven't seen since 1994. A lot of uncertainty around the budget. I think as a whole, unfortunately, it's not a budget that supports economic growth, and it's not great for the overburdened taxpayer. So I guess we'll have to wait and see if this budget will be passed through Parliament. But as far as tax is concerned, we haven't seen the normal bracket relief that we've become used to over time. It's notable that we haven't seen any increases in the abatements and the tax-free portions as far as the nation's tax, estate duty, capital gains tax are concerned. So we already have overburdened taxpayers and a tax base. And I think it's clear that we don't have any room for further increases in personal tax, nor on corporate tax. And it seems like, this VAT increase may be the last lever that government can pull, as opposed to spending cuts, which obviously they're not too keen on. And then there's a lot of talk about a wealth tax. And as I've mentioned, we actually have a wealth tax in South Africa. If you combine estate duty, the nation's tax, property taxes, capital gains tax, all of that taxes wealth. But it seems like there's a strong notion that an additional wealth tax may be introduced. So I guess we'll have to wait and see. And the question is if we'll see another layer of wealth tax being introduced over time. So my sense is that, as taxpayers, we need to watch this space. I think it's not the last we've heard of a wealth tax. And I think as advisors to clients and clients doing estate planning and structuring, it's something to take into consideration. And I think we shouldn't also forget that, there's a large allocation from Treasury to SARS. That's basically there to beef up their systems and to increase their ability, to collect tax and to curb anti-avoidance. So I think as advisors and as planners, we need to take that into account and ensure that the planning and structuring is done properly, because they are beefing up SARS's capabilities, and surely one needs to be prepared for that.
Absolutely, that's so true. But I can also imagine, in addition, with the grievances currently between the United States and South Africa, which has been in the media quite a lot recently, and the impact of that's rolled over. The sentiments are probably the same.
Damien, I think unfortunately, we found ourselves on the wrong side of Mr. Trump and the US, and that may have severe economic consequences for the country. But it's fascinating how quickly things change. A year ago, there was great optimism about the GNU, and actually money was starting to flow back into South Africa on the back of lower valuation of South African assets. And it's really sort of 6 months, 8 months down the line, and there's a whole change in the world order taking place. And I think as advisors and our clients need to be aware of this, that things can change quite quickly. And I think one needs to be prepared, to seize opportunities where they exist, and to also implement defensive strategies where that is required. So I think we've seen quite a bit of upheaval on the global stage, and it means that opportunities may be in different places than what we've become accustomed to, and we must make sure that we adjust our structures and our strategies to make provision for that.
And if I might just jump in, and good afternoon, everyone. Yeah, Francois, I definitely echo your sentiments. I guess from my perspective, living offshore and having the opportunity to travel back to South Africa on a fairly regular basis, it's definitely evident post the elections of last year that there was a noticeable change in the sentiment in South Africa with a lot more positivity. But again, I'm getting the impression that sentiment is somewhat souring, driven by some of the local issues that you've already touched on, and maybe the reemergence of load shedding, but more importantly, just some of the global uncertainty that has been brought with the new US presidency. And I think that if that negative sentiment does return, we may very well see another wave of people in South Africa looking to explore the creation of offshore asset solutions. And I mean, now might be a very opportune time to do that, given the strength of the rand or the relative weakness of the US dollar. So I think to your point, flexibility, this is, I think, become one of the very key aspects and considerations that people need to take into account when looking at an offshore structure. And really, as you said, just the ability to provide a bit of optionality, but also having to deal with the raft of additional compliance requirements, both locally and offshore, I think it's a very important consideration, and one that needs to be taken quite seriously with local trusted advisors.
Yeah, Brendan, I fully agree. And it's fascinating if you look at human nature. We tend to react quite swiftly and drastically on negative news, on negative sentiment. Responses used to be slower on when the tide is turning and we're getting positive signals. But I think it is important that one is geared to go both ways. So one should be positioned so that you can externalize funds, when the opportunities arise. But also, never say never. It may be that, as we've seen last year, South African assets were to be had at favorable valuations, and then your structure should be suited, to also allow for investments back into South Africa.
Yeah.
Thanks, Francois. Thanks, Brendan, for that. Speaking of, looking offshore and those considerations, Tanya, a question for you. What about immigration? What tax implications are there for residents that may want to pack up and leave the country?
Good afternoon, Damien, and good afternoon to all the attendees. So no changes were proposed to immigration-related tax rules. So it's business as usual. If you're immigrating from South Africa, you still prove non-tax residency via the ordinary resident test, your permanent home intent, or the physical presence test, 91 days a year over 5 years. The Section 9H exit tax sticks around taxing unrealized gains on your worldwide assets the day before you cease residency. So this is up to 18% for individuals. And then since March 2021, you can only withdraw lump sums from your retirement annuities, pension preservation funds, or your provident preservation after 3 uninterrupted years as a non-resident. But you might be impacted by the budget proposal if you're one of the many South Africans who have immigrated a couple of years ago and now returning to come back and retire in South Africa, or if you are a foreigner just wanting to retire here in South Africa. So currently, lump sums, pensions, annuities received by South African residents from foreign retirements linked to past employment outside of South Africa are usually exempt from tax, often due to the double taxation agreements, or what we call DTAs. The budget flagged this as a potential loophole leading to double non-taxation, where these amounts escape tax in both South Africa and the foreign jurisdictions. So the proposal aims to remove this exemption. Lump sums, pensions, and annuities from foreign retirement funds will now be taxable then in South Africa if you're a South African tax resident, when you receive them, regardless of where the employment occurred. National Treasury then is likely to renegotiate certain DTAs just to ensure that South Africa retains those taxing rights and then allow for you to rather claim those tax credits if you've already been taxed elsewhere.
Thanks, Tanya. That's very insightful around those issues. You know, immigration has been a very topical discussion and continues to be a very topical discussion, particularly in light of a lot of the uncertainties and, you know, some of the concerns that we experience in South Africa. That being said, though, I can't imagine the position offshore is all sunshine and roses. Francois, what considerations should clients take into account when they are setting their eyes abroad?
Damien, I think we should keep in mind that South Africa is to a large extent still catching up with the international community as far as regulation is concerned and compliance is concerned. So whenever you want to venture offshore and externalize assets and open investment accounts, etc., I think South Africans need to expect that, you know, there's going to be a lot of scrutiny. I mean, we know that South Africa is currently on the grey list. I think we'll maybe touch on that a bit later. But essentially, one can expect to jump through some serious hoops as far as compliance is concerned. So I think it's important for South Africans to be prepared. And I think one can expect to be requested supporting documentation, supporting source of wealth, source of funds. And I think if one can have that ready and in place, you know, that's a great first step. And I think one should also always keep in mind, if you want to externalize substantial amounts from South Africa, you need a tax clearance in some shape or form from the revenue authorities. So it would be a good idea to ensure that your local tax affairs are in order. So when the opportunity comes, you know, you don't have that hindrance where you actually want to externalize funds, you want to make use of an investment opportunity offshore, and you find that you can't actually externalize the funds, or you can't get bank accounts or investment accounts opened because you don't have your supporting documentation in place. I think South Africans should also keep in mind that when we consider establishing offshore structures and setting up investment vehicles, it's really a long-term objective, and it's of paramount importance to ensure that those structures are fit for purpose, because, you know, you're going to live with it for the long run. And, you know, these things come at a substantial cost. So one would also want to avoid, you know, redoing things and closing structures down and setting up different structures just because the cost offshore are quite prohibitive. So I think there's a lot that South Africans can do to prepare themselves, but I think they should expect, you know, that it's not going to be a bed of roses in terms of, you know, going through the compliance process.
Francois, going to add to your points and again wearing an offshore hat on, I've definitely noticed that there's been a major change in the mindset of people considering offshore structures. I mean, if I look back sort of 10 years ago, you know, people came across, set up offshore structures very quickly, made decisions very quickly in terms of actually incorporating entities or trusts. But I think as people have understood that the increased compliance, which obviously, as you pointed out, impacted on both the setup and the ongoing running cost considerations, I think people have become a little bit more mindful in terms of pulling the trigger on these offshore structures, making sure they're fit for purpose, making sure they could stand the test of SARS, for argument's sake. But I think more importantly, what we try and illustrate to clients going forward, that it's actually not so much the cost of setting up those structures and running them, but it's actually the cost of actually trying to unwind the structure if you've got it wrong. And I think that's a real consideration that is coming into the fore going forward. So again, you know, I reiterate the point you've made just around when considering an offshore structure, just to make sure it's fit for purpose and obviously getting the correct input and advice before executing on that offshore structure. So yeah, I totally agree with you.
Yeah, Brendan, I think in linking into that, I think when clients consider offshore structures and the service providers that they're going to partner with in setting up those structures, it's important to realize that, you know, it needs to be maintained going forward, and it needs to be revised as well. I mean, we're going to talk today about budget proposals, and we're going to focus on a number of changes. But essentially, it's important that you're partnering with service providers offshore that can assist, with the ongoing maintenance and the revision of the structures as maintenance is required as we go along.
Yeah.
Thanks, Francois. Thanks, Brendan, for that. Just still, following up from that discussion, it seems like there might be quite a bit of red tape associated with, the structuring, etc., and having a look at this. Brendan, what sort of regulatory considerations should clients be aware of when they are looking offshore?
So Damien, look, I mean, there's been a massive change, and as I mentioned, I moved to Mauritius sort of in 2007, end of 2006, and got involved in the offshore industry at that time. And then, on reflection, it was almost though offshore jurisdictions as a whole were operating in a bit of a vacuum. But I mean, as I think we'll touch on further down, is that the offshore environment, I don't think, could be any different to what it was back in that days. The raft of global legislation to standardize tax rates, the tightening of financial regulations around tax evasion and money laundering, all of these things have brought an added layer of complexity from an offshore perspective. We've also seen, both in South Africa, but in Mauritius for the same reasons, the introduction of enhanced Know Your Client, UBO declarations, anti-money laundering due diligence, and then, of course, the ongoing intergovernment and tax authority reporting under CRS and FATCA. So, there is a plethora of new considerations to take into account. As I said, they're not insurpassable, but it certainly needs to be given some thought of when you are going to set up a structure that these are going to be ongoing compliance. And I don't see them falling away at any stage in the near future.
No, thanks, Brendan. I think those are very important points and very important considerations for everybody who either has interests offshore or are looking to, establish such interests in the future. Turning back our attention a bit locally, right now, a very contentious issue and a question for Tanya there on that one is obviously the VAT increase that's been announced and suggested in the budget speech that happened. So, Tanya, lots of things in the media about that, a lot of uncertainty around the VAT increase, etc. I think there's a lot of people that have a lot of questions. When exactly, because it's going to impact a lot of businesses, not only, from a tax compliance perspective and the need to actually collect the right amount of tax and pay it over, but also from an administrative perspective within a business, it's quite a lot that needs to be done in the circumstances in light of this uncertainty. So when exactly will the VAT increase, as was proposed in the national budget, now actually be implemented?
So this is a very interesting and possibly a very messy scenario this year. So the budget speech proposed a two-step VAT hike, 0.5% starting the 1st of May 2025, and then another one, 0.5% in 2026, bringing it to a total of 16%. The interesting thing is that under Section 7(4) of the VAT Act, when the minister announces a rate change in the national budget, it takes effect on that specified date, so the 1st of May 2025. But the Act then requires Parliament to amend that legislation within 12 months to lock in that new rate permanently. So if Parliament does not manage to get Parliament's approval by 30th of April 2026, we have a legal problem. So from what I understand from a legal opinion of a senior parliamentary legal advisor that was reported this morning in Business Day, in a Business Day issue, amendments to the fiscal framework and revenue proposals cannot even prevent the increase of the rates of that starting on the 1st of May. So if you wanted to modify that or roll that back, that increase, it would require the introduction of a completely new money bill. But only the finance minister has the authority to introduce such a bill. So for accountants, the practical reality kicks in immediately on the 1st of May 2025. SARS expects all businesses registered for VAT to charge 15.5% on taxable supplies from the 1st of May. Systems must be updated, invoices need to be adjusted, output tax needs to be calculated at that new rate. We have no choice but to comply. So SARS doesn't wait for those parliamentary debates to enforce what's been announced. Now, what happens if Parliament doesn't enact this increase by the 30th of April 2026? Here's where it gets messy. So legally, if the VAT Act isn't amended within that 12-month window, the rate technically reverts back to 15% unless SARS or Treasury issues guidance otherwise. Practically, this of course creates chaos. Businesses would have already collected the 15.5% VAT for that period, paid it over to SARS and claimed tax at that rate. So if the increase isn't legislated, SARS could potentially demand vendors to reconcile back to that 15% retroactively. So it could potentially be a compliance headache. And as we all know, the budget is really contentious. Parliament's approval isn't certain at all. So we'll have to see how it plays out.
No, thanks, Tanya. Wow, that really is quite an interesting consideration this year. Also, striking a bit of, concern. Very important issue that we'll need to keep an eye on, especially everyone that is impacted by that going forward over the next few months to see how the circumstances actually evolve. Speaking of tax, though, are there any other proposed changes to the tax laws that might impact personal investment structures locally or offshore?
Yes, so the budget constantly shapes investment structures, as Francois also alluded to, and it's likely to do so again this year. So firstly, as Francois also mentioned, there's a definite tax creep on individuals. So once again, no inflation adjustments to the personal income tax brackets or the personal income tax rebates. The medical scheme credits have been frozen as well, as expected, and it's likely to eventually fall away when and if the NHI ever comes in. But the important trend to note that even though we don't have official wealth taxes in place, which would be taxes based on market value of assets, the tax system is very much focused on equality through using existing indirect wealth taxes, as Francois also said. So for example, the budget hasn't raised the estate duty abatement since 2007. It's still sitting at that 3.5 million. Exempt donations have also remained at 100,000. Capital gains tax exemption at 40,000. That hasn't been increased since 2016. So you can imagine if that 3.5 million estate duty abatement was increased with inflation annually, it would have been more or less 20 million per individual by now, or 40 million for a married couple, which would have excluded a significant number of individuals from estate duty. So this just strengthens the case again for proper estate planning through trusts for a much wider net of individuals who wants to preserve wealth for their next generation. By moving assets into a trust, you of course cap your personal taxable estate, and you also shield that growth from individuals' tax creep, which seems to just growing every year. On the other hand, the good news is that SARS interest rates have been on a downward trend since June 2023. It's again been adjusted downward with 0.25% effective the 1st of Feb 2025 for the official interest rates. So this is the rate that we use for funding of our investment structures locally and offshore. And the 1st of March 2025 for the prescribed rates on balances owing to or from SARS. So that's great news for personal investment structuring. It will be much cheaper now to move those funds into personal investment trust or company structure locally and offshore compared to 2 years ago. And yes, of course, lower interest rates definitely incentivize proactive investing through these trust structures over just parking cash. A third proposal to take note of perhaps is cross-border loans between connected persons. The budget recommends refining Section 24I, subsection 10A of the Income Tax Act, specifically looking into how exchange differences are deferred on loans between related companies. This is applicable, for example, for a South African entity lending to its offshore subsidiary in a currency other than Rand. Previously, unrealized forex gains or losses would be deferred until that loan was settled. So this refinement might accelerate recognition of those gains or losses, depending on how SARS then strengthens or tightens these rules. And then finally, the budget is again refining the definition of hybrid equity instruments. So specifically in terms of preference shares. Preference shares seems to come up every year. So Treasury doesn't seem to like it at all. Hybrid instruments are often treated as debt as opposed to equity for tax purposes, so that we can deduct that interest in the company issuing those preference shares. If SARS narrows what qualifies, for example, by targeting these preference shares with these equity-like features, it could limit interest deductions for companies issuing them. So also one to watch.
Tanya, I think if I can maybe just
Yeah,
add to
sorry, go
that.
for it.
Sorry, we know that foreign currency loans or funding mechanisms between South Africans and their connected parties, which includes offshore companies and trusts, are quite commonly used. So what you're saying, I think, needs to perk the attention of everyone that is considering structures like that or have implemented structures like that, and just to speak to the advances again, and just to see what the impact of these changes will be.
Absolutely.
You stole my thunder there, Francois.
Oh, sorry, Dan.
No, thanks, Tanya. And as Francois said, it's a very important considerations that came out there that we need to take into account, particularly those that are people that have structures or are looking to structure them or have similar things in place, as well as from a personal income tax perspective. When considering, the concept of ultimate beneficial ownership, which is an international standard in compliance, and looking towards identifying, who sits behind all these structures and all the rest of these things, we will talk about it in a bit more detail from a South African perspective just now. But, from an international perspective and, the whole red tape and compliance obligations around identifying the ultimate beneficial owners in businesses, structures, personal investment vehicles, etc. Brendan, how is the world reacting to ultimate beneficial ownership disclosures and information sharing? Are we experiencing any resistance in this regard, particularly the increase in this type of compliance over the last few years?
Yeah, I mean, I think the key point about sort of ultimate beneficial owner declarations and transparency in terms of UBOs is that disclosure, I think, is here to stay. I mean, I can talk on behalf of just Singapore and Mauritius are two jurisdictions that I'm involved in, but whether you are a shareholder in a company, an investor to a private equity fund, or a settler of a trust, the first documents you're going to be asked is basically to disclose who's behind the structures. So I don't think we're going to move away from it. I think it's a global norm. And I think there are three pillars of thinking in terms of, how people are perceiving this declaration, which I think are all fairly valid. So the first one, I think, is people have raised some valid and relevant concerns around the erosion of financial privacy. And I think we've seen that where people are using offshore structures for legitimate reasons, but are being caught up in information data leaks and the likes of the Panama Papers, and are being branded as doing something wrong. So again, I think there is some of that concern, but again, I know a lot of the regulators and financial authorities in the jurisdictions are really pushing licensed and regulated entities to ensure their data security is of the utmost importance. I think from a business perspective and from a transactional side of things, it certainly is also, potentially impacting on the speed of executing investments, because there's no limit to the amount of documents that a bank or a regulator may ask, and so I think that could hinder doing business going forward. But I think lastly, maybe the good thing that's coming out of it is that, again, I think it's very important that you've got to understand that these disclosures are going to be required and here to stay, and they're going to be ongoing. And I think because people are taking it a bit more seriously in terms of, those disclosures, I think it might also end up in providing a more transparent and stable financial system, which again could help in mitigating risk for investors looking and using offshore solutions. So, I think there are three schools of thought, but I think ultimately, that the ultimate disclosures are here to stay. That's what it is.
Yeah, Brendan, just linking into that, as you say, it's here to stay. So what we've seen is the reporting that will be done on a structure and the information that will be shared, and how that will be managed is becoming quite an important cornerstone of any structure. So we always used to focus quite a bit on the estate planning side and the tax side and the legal side of things. But this reporting of information and managing the flow of information is nowadays as important as the tax planning side of things. And I think it's just important for clients to, once again, when they partner with advisors or with service providers, that they also put that in their sort of criteria, that they should be able to efficiently deal with reporting and disclosing of information, because otherwise you could really sort of get it wrong, and you may actually lose quite a bit of the benefit of implementing your structure.
Yeah, I totally agree.
Thanks, Brendan. Thanks, Francois. I think, yes, that's very important, for everyone to note and to understand and get used to that environment of ultimate beneficial ownership declarations, and the fact that that is a global trend, to get into that mindset when looking at actually structuring their affairs. I mean, also in South Africa at a domestic level, we've seen quite a bit of ramping up of, our enforcement on and amendment of the legislative framework in relation to combat money laundering, etc., which has been a big consideration. As we all know, we were grey-listed by the Financial Action Task Force. And, in order to get off of that grey list, which has not been great from an economic perspective, South Africa was required to not only tighten its legislative framework to bring it more in line with international standards, including the ultimate beneficial ownership considerations, which we've discussed now, but also to show a significant increase in our enforcement of that legislation, how it's being implemented at ground level, audits, investigations, and also sanctions being handed out for non-compliance. We saw a wave of amendments with the anti-money laundering legislation that came in, amending company law and trust law, bringing in this concept of ultimate beneficial ownership declarations that have come in. As we all know, these need to be reported now, new obligations for trusts and companies, submissions of these beneficial ownership structures to the master and to the CRPC. A lot of the regulatory authorities now talking to each other and sharing that information, including with SARS. And the Financial Intelligence Centre, who also implements the Financial Intelligence Centre Act on accountable institutions. I mean, just last week, the week before last, the Financial Intelligence Centre, for example, issued a new directive that all accountable institutions had to submit updated risk management and compliance programs by last week, exactly a week ago, the 12th of March. By the deadline at 5 o'clock in the afternoon, and not doing so would have now constituted a sense of non-compliance with that requirement. It also had to be signed off correctly with the correct authority matrices, a lot of which, as the Financial Intelligence Centre has clarified over the last few months in guidance notes, BCCs, etc., that they've published, including clarifications also on ultimate beneficial ownership and how we view that in South Africa, bringing that down to 5%. So there was quite a lot of clarity that came in the last few months that have been incorporated into needs to be management and compliance programs. So essentially the statistics that are currently becoming available is that only a fraction of accountable institutions that are registered actually submitted those updated risk management, which is not fantastic, since obviously not submitting was non-compliance, but now also they will have a direct record of all accountable institutions as RMCPs, which they can now audit directly from the system as well to ensure that these are compliant or not. These are just some of the examples of how they are ramping up enforcement in order to provide that evidence that they are busy enforcing the act. So there's definitely a strong drive for this in South Africa as well. So on that note of beneficial ownership and enforcement from that perspective, Andre, so since this has been now introduced, and obviously it's being pushed to make sure that we have the evidence to get off of the grey list, hopefully in the near future, which we'll also touch on just now, what impact has this all had on estate planning?
Yeah, Damien, I think the introduction of the ultimate beneficial ownership regulations in South Africa has definitely undeniably had an impact on estate planning practices. And as you said, these regulations were put in place for the purpose to enhance transparency and to fight financial crimes. But from an estate planning perspective, I think the most notable effect, as Brendan also mentioned earlier, is that there's now a reduction in financial privacy that was previously associated with, with certain structures used predominantly to protect your wealth and your assets in various countries or jurisdictions. So with the ultimate beneficial ownership regulations now in force, trust and companies are required to identify and disclose the individuals who ultimately own or control the assets. So it's essential to ensure that the beneficial owners of these structures are properly identified and disclosed. I think it's now more important than ever before. And I mean, it's very clear that there's more focus now on regulatory compliance than on financial privacy. Ultimately urging clients and their advisors to carefully balance these two priorities. I think another key consideration that must be kept in mind when doing estate planning and structuring is that the ultimate beneficial ownership disclosure requirements are not confined to South Africa alone. So for your clients with assets or structures across multiple jurisdictions, it's definitely crucial that the beneficial ownership information of these structures are accurate and consistent, and that it's also compliant with the regulations in each of the relevant countries where those assets are situated. I think an important thing to keep in mind is that the estate planners, together with your financial advisors and your accountant, they must be able to navigate these regulations, ensuring that the client's ultimate beneficial ownership details are accurately reported and aligned with each jurisdiction's rules. And that's why I believe it's important that your advisors need to have a form of a collaborative relationship, especially if you consider having offshore structures for estate planning, legitimate estate planning purposes. So, Damien, I think to conclude on that question from my side, I agree that the ultimate beneficial ownership regulations are designed to enhance transparency and to strengthen anti-money laundering efforts, which is a very good thing. But they do obviously present new challenges for estate planning in South Africa. The need to strike a balance between disclosure and the client's financial privacy and asset protection desires are now more important than ever. So I think estate planners and your advisors, they must remain proactive and help clients to navigate these compliance regulations, both locally and also internationally, and to ensure that you maintain an effective estate plan in a evolving regulatory landscape.
Thanks, Andre. That's definitely very insightful from an estate planning perspective as well. Tanya, in light of what Andre is saying, like, how do you foresee SARS stepping up its enforcement in relation to these considerations?
Damien, so to date, there was no explicit announcement that SARS will immediately start cross-referencing beneficial ownership data from e-filing with the CIPC or Master's Office. The budget review also didn't spell it out, but there's definitely strong signals that SARS is either already gearing up for it or already has the capability. SARS invested heavily in digital infrastructure. They're upgrading e-filing, and they now also have advanced data analytics. So they're definitely building a net to catch discrepancies. And as we discussed during the 2024 budget proposal, SARS has a renewed energy to ensure taxpayers comply with existing tax laws. The CIPC and SARS already share some data, as you've already discussed indirectly, like company registration details. Since 2023, the Financial Intelligence Center has had access to CIPC's beneficial ownership register. And SARS, as a key player in the anti-money laundering network, likely taps into this too. So add the Master's Office to all of that, which tracks trust deeds and estate info, and you've got a web of data that SARS can cross-check against tax filings. So no announcement needed. They are quietly building that network. Why does that matter? So beneficial ownership, in other words, who really controls a company or a trust, is a gold mine for SARS to sniff out tax evasion or hidden wealth. If your trust beneficial owners on e-filing don't match the Master's office records, or if a company's CIPC filings show different owners, SARS will most definitely flag it. Their analytics can already spot patterns. So, for example, a trust claiming losses while its beneficial owner is living large offshore will be flagged. And that's not hypothetical. It's the direction that they've been heading since the 2021 Panama Papers push. And the other side to this, SARS has taken a hardline stance. Trustees aren't just custodians anymore. They are considered to be now the enforcers of tax obligations. Now, if we tie this to the 2025 budget, there's a proposal to also extend trustee liability even in insolvent estates. Currently, trustees are already jointly and personally liable for a trust's tax compliance in their official and their personal capacity. The budget now takes it even further, saying if an estate goes insolvent, the trustees are responsible to report any income that insolvent person earned before sequestration, not just after. So again, SARS is looking at trustees to enforce tax obligations and not just merely be custodians.
Tanya, I think just perhaps to add to what you said in of SARS investment in its infrastructure, I think it definitely suggests that SARS is preparing to streamline its processes and to strengthen its enforcement and cross-referencing efforts. I think what's also important is that we need to keep in mind that SARS is considered one of the best tax collectors in the world. I think their compliance efforts have proven to bear fruit even despite the tough prevailing economic conditions of the past couple of years. And without having to go into too much detail, the figures released by SARS indicate that in the 2023-2024 fiscal year, SARS has collected a record net amount after refunds of approximately 54 billion rand more than the previous 2022-2023 fiscal year.
Yeah.
So that is definitely proof that SARS, they are working hard in the background. And while we don't have immediate confirmation, I do agree that the direction SARS is heading with its enhanced capabilities and ongoing investment in data infrastructure definitely suggests a more robust enforcement in terms of beneficial ownership reporting and the validation of data, and that's definitely something that's on the horizon. And I think as a result of that, we can expect them to increasingly focus on cross-referencing data and to ensure that all relevant information is accurately reported. And it's very clear that this approach will not only strengthen SARS' ability to collect taxes more efficiently, but I think it will also ensure that those who are non-compliant are held accountable. So it's important that your estate planners and your accountants and your financial advisors and the like, they need to stay attentive to these changes, and they need to be prepared for such changes as well.
Yep, fully agree. Yeah, and we're already seeing it in the amount of SARS audits we're getting as well. So they're stepping things up.
Thanks, Tanya. Thanks, Andrea. I think yes, very important points. And I think what is quite clear from what it is that you're saying is like, at a domestic level, not only compliance environment and making sure that you comply with that environment becoming increasingly more complex with a lot more administration that's being placed not only on clients but also on practitioners and advisors. That is becoming a more complex environment, but you obviously cannot afford to be non-compliant because the enforcement really is being stepped up, particularly with SARS pushing, Financial Intelligence Center pushing, etc. So given this increased complex environment and the additional significant additional burden that's being driven by the enforcement, how are practitioners coping with all of these additional efforts?
Well, not at all. So no, the consequences of being grey-listed hits South African accountants and trustees like a train. Add the country's financial crisis and SARS drive to collect more money from taxpayers, accountants are really struggling to cope. I sit on one of SAICA's monthly forums, and very few accountants actually manage to make all the various new deadlines for their clients. Those of us that have managed to cope have had to expand our workforce quite a bit and invest in fiduciary departments. In my opinion, it definitely helps to have segregation of duties between a dedicated professional trustee and a dedicated accountant, because both have more than enough to do. But as Brendan also mentioned, it's not always a cost that the market can or is willing to absorb. So service providers tend to be working much harder for much less money.
Fortunately so.
Interesting. Thanks, Tanya. That gives a bit of insight from a practical perspective there. Speaking of, enforcement and this bigger drive with all of these things that have come in place, particularly with the drive of not only getting us compliant on an international perspective, an international level. Obviously, we'd like to get off the grey list. I understand there's probably only about 2 more requirements that we need to hit by June, July this year to be seriously considered to be removed from that grey list in October of this year. So hopefully, if we're lucky, we could potentially look to be removed from that grey list if they continue with tightening the enforcement, etc. Brendan, how does this, if we could get off of the grey list, if we're lucky from that perspective, how does that affect the appetite of investment in South Africa?
Well, Damien, I think just the process of getting off the grey list is unfortunately doesn't involve any luck. It involves hard work, and Mauritius is all too aware of that, having been put on the grey list back in 2020. I think the benefit Mauritius had was it's obviously a far smaller economy, and so it was nimble enough to get itself off the grey list quite quickly. But I think really what maybe people don't take into consideration is that there are ongoing reputational effects of being blacklisted. And I think in Mauritius, we're still suffering that today. So the question is, if South Africa can get off the blacklist, the grey list, I definitely think it will improve investor sentiment. I think being on the grey list has numerous effects, not only from borrowing costs, but, it impacts on DFIs, potentially backing private equity funds going into South African assets. So I think the knock-on effect has been quite big, and we've certainly seen it from investment flows. And so, so I'd like to think that if South Africa can get off that grey list, that will certainly give it a boost from an investor confidence side. And I just hope that the rest of what's going on in the world doesn't cloud that effort if it does come off the list back in October later this year.
Thanks, Brendan. I think that helps a little bit in understanding that picture a little bit. It does seem positive. Thanks for that. Andre, considering that South Africa may become more attractive to investors given what Brendan has said, both locally and internationally, how should clients approach their estate planning? What would you say is important for estate planning in this regard?
Damien, well, first of all, I agree fully with Brendan regarding the fact that there will be a positive shift in the investor sentiment as South Africa moves off the grey list. And this is definitely important for estate planning, because as the investment climate evolves, so should your estate planning. And this makes it even more crucial, as Francois also mentioned earlier, that you need to ensure that your estate planning strategies are flexible enough to account for example, the expatriation and repatriation of funds, especially considering the global financial uncertainty we've experienced or that we experience from time to time across the world. So it's vital to consider how the changes in the investment landscape, both locally and internationally, could impact your wealth and asset protection strategies, and you need to be able to adapt your estate plan in line with these changes. I think another thing that one also need to keep in mind is that there's various other challenges on the horizon that necessitates a flexible and adaptive strategy. It's been mentioned that South Africa's tax rates are already relatively high, and it was made clear by the Minister of Finance that there are no further increases in personal or corporate taxes at this point in time, because this could risk discouraging investments, and particularly from your international sources. And as Francois alluded to earlier, it leaves government with that as sort of one of the last levers that can be pulled to improve revenue. However, we know that if you raise VAT too much, this can also have various negative effects, especially on your lower income households. And therefore, I believe because government are running out of options, there's definitely a major potential for the introduction of an additional wealth tax in the near future, as Tanya also mentioned. We know that there have been ongoing discussions on this topic, and it resurfaced now in various political and economic debates over the past couple of months. So while there's been no official move in this direction yet, it's certainly a possibility in the future, because a wealth tax or an additional wealth tax can be seen as a way to increase revenue. However, implementing such a wealth tax would also come with significant challenges, and it's something that will, in my view, it's likely that it will be continued to be debated as government looks into ways to increase revenue without stifling economic growth. So we will have to wait and see. But I think one thing is clear, and that is that things can change very quickly, and therefore it's crucial that clients must ensure that their estate plans are flexible and adaptable to both local and offshore changes, or local and international changes, allowing them to adapt quickly and to take full advantage of positive movements in the investment market.
Thanks, Andre, and also thanks to the panelists for all their inputs around the discussions around these questions. I think, important takeaways from today's circumstances, in addition to everything, is that definitely that we're living in very interesting times currently. There's a lot going on, not just in South Africa, but internationally as well. The bigger picture is also completely interconnected with all of these complexities. A lot of, areas for concern, a lot more things becoming a bit more complicated. But of course, as we're seeing, there's also a lot more opportunities if we stay on top of it and stay informed. So important to stay informed, make sure you stay up to date with your advisors, remain adaptive in the approach of the circumstances, particularly in this ramp up of enforcement coming from the regulatory authorities, and then also, to make sure that things remain optimal and that the planning remains optimal in the circumstances. So thanks for that. Thank you very much to our expert panelists for their contributions on these very important points and for the very interesting chat in this regard. We'll now turn to look to answering some questions that we may have from our guests this afternoon. We have a question posted in the Q&A, which I will address to the panel. Was there any consideration of extending Section 12BA of the Income Tax Act, 125% of the investment?
I can maybe answer that question. So Section 12BA of the Act provides 125% tax deduction for investments in new and unused renewable energy assets brought into use between March the 1st, 2023, and I think it was up until Feb 28, 25. So it would have ended 2025. So this was just a temporary incentive that was introduced in the 2023 budget to address the energy crisis that we had. I know there's been a lot of discussions whether or not it should have been extended or not, but with the announcement, nothing was said about the extension. So I would maybe just wait for the final act to be signed, the final budget to come through and approved and everything. But at this stage, there's nothing been announced that is suggesting it's going to be extended. If it's going to be extended, it might just be for one more year, but there's nothing concrete yet.
Thanks, Tanya. I think that's very helpful. I think we'll give a few more seconds if there's anybody else that would like to pose any specific questions. In the meantime, I can also confirm if you might not have a question today, but if you have any questions or anything you'd like to discuss or any further insights needed after the webinar is over, you're also more than welcome to contact us, and we will best assist you in answering those questions if anything comes up or that you may not think of afterwards. Okay, great. It doesn't seem like we have any more questions coming through at this stage. So, oh wait, it looks like we have one more. No. Okay. Thank you very much to the panelists again this afternoon, and thank you to all of our guests who took the time to participate and have this discussion with us. Really enjoyed it. As I said, very important takeaways from today and things that we need to continue monitoring and taking into account and remaining up to date going forward. Thank you very much to everyone. Have a fantastic afternoon and keep well. Thank you very much.